Thank you all for joining us. My name is Stephanie Whited. I'm a senior manager at the International Federation of Accountants. Welcome to Achieving Investor Grade GHG Reporting, the role of accounting and finance professionals. This event is presented by IFAC and the We Mean Business Coalition as part of Climate Week NYC. We had about 1,000 registrations for the event, so exciting to see all of you here and the interest. Before we get started, a couple of housekeeping notes. This webinar is being recorded and will be published on IFAC's YouTube channel, website, and social media in the coming weeks. If you have a question over the course of the event, you can add it to the Q&A box at the bottom of the screen. We will address questions live, time permitting, towards the end of the event. To kick us off today, I'll now pass the mic to the moderator of our panel discussion, Stathis Gould, Director at IFAC. Over to you, Stathis.
Thank you very much, Steph. Welcome to all of you from around the globe for this Climate Week webinar on achieving investor-grade GHG reporting and the role of accounting and finance professionals. My name is Stathis Gould, and I'll be moderating the panel today for a very timely and relevant topic for the accountancy profession. So we know the corporate reporting landscape is evolving quickly, moving from voluntary to mandatory sustainability reporting and disclosure requirements in many markets. The new IFRS sustainability disclosure standards represent a global baseline that requires sustainability-related financial disclosures to be issued at the same time as the financial statements and for the same reporting period. Together with jurisdictional developments, including the European Sustainability Reporting Standards and the proposed rules for climate change disclosures by the US Securities and Exchange Commission, these developments require a step change in the quality of sustainability information to meet the information needs of investors and other stakeholders. Accounting and finance professionals are increasingly involved in their organizations to implement the processes and systems to bring about trusted GHG reporting to both management and capital markets, and to connect financial and emissions data processes and systems. Whoever we are in the information value chain, as preparers, senior management, board and audit committee members, or working in firms, accountants can apply their professional skill set to transform high quality standards into high quality information. Our panel discussion today will build on the guidance we recently issued with the We Mean Business Coalition and other partners available on the IFAC website. 8 steps to enhancing GHG reporting, a roadmap for accounting and finance professionals, provides a roadmap to engage with others across your organizations to prepare GHG emissions reporting requirements aligned to financial reporting processes and cycles. And a supplementary document, GHG Reporting Building Blocks for Accountants, which provides technical guidance to collect and enhance the quality of data related to all scopes of GHG emissions. So in today's 1-hour webinar, we will discuss with our panel of experts the latest developments from 4 perspectives. Jane Jagd and Eugene Brink from a corporate finance and accounting function viewpoint, Elizabeth Seeger and Mike Harris from a reporting and audit and assurance standard setting viewpoint, and Jimmy Greer with a data and technology perspective. We will discuss their thoughts on enhancing reporting on climate-related risk and opportunity, and specifically GHG emissions, by bringing together GHG emissions data into financial and disclosure processes. We hope you'll leave today's session with a path forward towards achieving investor-grade GHG reporting at your organization. So let's kick off with Jane Jagd, Director of Net Zero Finance at the We Mean Business Coalition and former lead compliance officer at 2 large companies, Maersk and Ørsted. Jane, you'll set the scene. We worked together very closely to develop the GHG reporting roadmap and guidance for CFOs, accountants, and finance professionals. Can you tell us a little bit about your experiences and advice on how to meet the need for investor-grade GHG emissions information, also in the context of your experience at Maersk and Ørsted, and perhaps raising and highlighting some of the key recommendations we made in our guidance?
Yeah, definitely. Thank you so much, Stathis. I should start by mentioning my background is also financial, so I do understand all the financial people who may start by thinking, greenhouse gas reporting, I don't know anything about that. But in reality, you have all the skills to do this well. Because in reality, we can reuse a lot of the information that is already in the bookkeeping system, and we can reuse a lot of our skills on making good processes, making sure we have evidences for the data that we are to report. So in that sense, we have a fantastic setup if we are combining both the financial and non-financial colleagues in the companies. But I do understand that it's difficult. I would like to make one thing clear, and that is greenhouse gas reporting is extremely rarely based on measurements. It is most often based on quantities multiplied with a factor. And that is something financial people do understand how to do. So this is something that that you should bear in mind. It is not as difficult as some consultants might want it to sound like. It is really not.
Thank you, Jane. So in terms of some of the recommendations that we've made in the roadmap, I'd say there's a common theme that runs throughout everything that we talk about, which is the need for effective collaboration and business partnership across the organization. Can you just sort of bring to life some of the critical touch points and areas of collaboration between finance and other areas of the business?
Yeah, definitely. As we know, financial people are really good at making effective processes. We are really good at data collecting and really good at also making sure that there are evidences for the data. But what we potentially are less fantastic at is to, for instance, develop explanations for data development. And this is where perhaps the sustainability department is much, much better equipped, because they have a much stronger connection with the operations. And this is how the co-work can begin, but also to, for instance, understand some of the finer details of the greenhouse gas protocol. This is where sustainability colleagues might be better equipped, and financial people can then be really good at pointing at, whoops, our electricity bills, they are scanned. And then we could potentially also scan the kilowatt hours. It's not that difficult. Perhaps we already do it. We just didn't know it, and that we should use it for anything. But this is where the co-work can actually really team up. And you will also notice very fast that you could potentially also reduce some of your cost if you have that knowledge about what each other are really good at.
Jane, so that's really interesting. So in terms of actually improving the sort of cost effectiveness of collecting relevant material GHG emissions data, and the role of technology, and leveraging and deploying existing systems within the company, what is your experience around how to achieve that?
It's actually far simpler than you think. Most bookkeeping systems, most ERP systems are already equipped to measure quantities. When you book a posting, you get the cost, obviously, but then you can also book the quantities. You do that very often if you, for instance, also buy other things for your inventories, then you also have quantities. And sometimes it's only a matter of that you turn on that functionality. So it's not very difficult, and it's not expensive, and you don't have to buy new systems to make greenhouse gas reporting. You can use your existing bookkeeping system for that. And the good thing about that is that you can actually use the financial data to assure that your non-financial data is complete, which it can be a bit difficult if you don't have some boundaries to make sure that that is right.
Well, just one last question for now. Obviously, one of the more tricky areas of GHG emissions accounting and reporting is achieving comparability and consistency, which are core principles of financial reporting, of course. In terms of achieving comparability and consistency in GHG reporting, organizational boundaries can be one of the most challenging aspects. Can you talk a little bit about how to think about organizational boundaries and to address some of the challenges, particularly to ensure that the information being disclosed is decision useful for investors as well as management?
Yeah. You can say in some jurisdictions, it is also, for instance, required that you make integrated KPIs like greenhouse gas per revenue. And then the comparability is essential. And therefore, for instance, your consolidation of data will have to be done in the same way. And therefore, I also recommend you use your financial consolidation system to do this. So it is imperative for your reporting that you can compare one set of data with the other set of data. Otherwise, it will be very difficult to make any sense out of the greenhouse gas report, because if there is no context for it, it actually says nothing about anything. So therefore, is the financial context enormously important to be able to tell, are we actually reducing our emissions or are we not, compared to the production we have?
Thank you, Jane. That's really helpful. So we'll come back to some of those points that you've addressed in our panel discussion. But just moving on to Eugene Brink. Eugene, thank you for joining us. You're the Finance Transformation Leader at GE Vernova. So just to kick off, can you just tell us a little bit about your work at General Electric and what your climate targets and current progress against these are, and in particular how finance and accounting is contributing to your overall climate agenda, and in relation to sort of understanding your GHG emissions footprint?
So, Steph, thanks for the invitation. Let me first say, I think the work you and the team are doing here to create a common framework is huge, and appreciate a spot on a panel and something as exciting as Climate Week. So, as you know, GE, 130-year-old company, we're in the process of actually creating 3 independent publicly traded companies. So, the beginning of this year, we spun off here an IPO, our healthcare business, and we're currently working towards our second spin-off, which is separating the energy business from our aviation business. And so I work for the energy business, which we've named GE Vernova. Where this becomes really close to home for us is we support 30% of the planet's electricity generation. And so, as you can imagine, we are a substantial, participant in Scope 3 emissions. But at the same time, this also presents a huge opportunity, what we think is one of our core opportunities, and that's really to decarbonize the world's electricity generation. So that then brings in, at a G level, our publicly announced targets is carbon neutrality within our own operations, which is Scope 1 and 2 by 2030. But the bigger, loftier goal that's more meaningful is to be net zero on new sold products by 2050. And so it's a myriad of new technologies that I'd love to go in for hours and hours, but ultimately it's how we shift the landscape of electricity generation over time. We're in 140 countries today. We have 55 ERPs. We have 2,000 IT applications. Everything Jane said, I couldn't agree with more. And in fact, we spoke several months ago and I stepped out of that and I was like, we've got this. We can do this. This is actually in our wheelhouse. And I think finance plays a really kind of tight role in this thing. One really needs to resist the urge of, implementing the new shiny toy or, adding additional technology stacks here, because to a point exactly, a lot of this stuff exists. Our core ERPs continue to evolve. There's a huge amount of capability. And the reality is we don't fully utilize those capabilities in the right way. No question. The electricity invoice it's a great example of something that's just relatively easy. You got scanning technology. It picks up the amount, picks up the type of spend, picks up the date, picks up the vendor. So it both gets into the system how we pay the vendor. It also puts into the system how you record the expense. And we've got a myriad of controls around capturing that, making sure that's right, reconciling it to the back end. Adding that additional capability on just capturing that non-financial data is not overly difficult, and we're able actually to include it into our scanning. I call it machine learning, but that sounds a bit fancy. It was actually a lot simpler than that. And so then once you capture it, to Jane's point, you put it into a data calculator, which is, again, just it's a relatively simple kind of P times Q calculation by jurisdiction. And that generates a few. Our 55 ERPs has its own challenges by any means, but at its core is we run a pretty consistent accounts payable kind of flow. And so I think, and you apply that same to car fleets, there's a myriad of other things that you play that same example. But I would urge everyone, use that. It's a very easy example that everyone gets their head around very quickly, and it kind of scales from there. I think by doing this, again, we're creating standard work, we're creating processes and data feeds, and we're avoiding what I hate in this world more than anything is manual collections. And you can imagine 140 countries, we've got 900 physical manufacturing or office sites. Manual capture will just bring the whole system down. I think, finance is a total key strategic partner because at our core, we know what good looks like. We're system experts, and we actually understand the system architecture. So with all that said, though, we've got a ton of wood to chop. And I think our focus is very much on that architecture, the flow, but also the timeliness and the precision of that reporting.
Thanks, Eugene. That's really, really helpful. So you characterized finance as a strategic business partner. What are some of the key functions, corporate functions within the business that you're really working with, and how do you navigate things like differences in sort of culture and mindset?
Look, more broadly, you're kind of playing through want to go in this. The way I think about it is there's two. One is just a pure defensive play. It's a compliance. How do I work through the compliance exercise? Invariably, everybody is going to be pulled into this, either because you've got European operations or you've got European customers. If you view this thing as a compliance play, it's okay. It doesn't mandate that. It doesn't mandate that they're an production play. The second approach is really play, where one evolves it from just a compliance to from compliance and optimization to some form of monetization. And said, sense that how do you focus with what's important to your customers? How do you align with where your sustainability perspective, and then how do you build that into your narrative and your culture as far as how you align to that and how you support to that? And I think as a US preparer, we are behind our European counterparts. I think that the reality is true, and I think things like frameworks and so forth are going to help. But I think the starting point where many of us come behind peers and our competitors is that approach this strategically, build capabilities around operational capabilities, building this mechanism. I think where finance is very helpful is helping to kind of balance what that looks like and what those kind of key metrics can be. But the starting point has to be, what are your sustainability operations tied to a customer output? How does investor relations wish to things? And then how do we align to a metric that's an operation? We'll figure out the report. It's kind of aligning to that. And time there's a lot of math and science and P times Q's in this thing, but keep it relatively simple, but keep it consistent. And I think if you look at it, how they calculate some of these KPIs keep evolving, and you kind of lose your audience quite quickly when you keep changing. Now I get everyone's getting smarter about this, and it's maybe everyone's finding a better how to. But I think putting that time up front as far as what is the narrative we want to drive, and ultimately what is the KPI that we're going to use to measure our business on, and it's good because that's the thing that kind of you get everyone apart. And I'll use it most simply this week is my new role, my transformation lead. My focus is very much on how do we just run this place better, cheaper.
Yeah. And
very often I approach things, I'm like, how do I take cost out? And we were looking at some of our footprints, and somebody just had the reaction to say, Eugene, you're so focused on cost, but just think what this does to our footprint if we can take these properties out. It gives another kind of why this is, and I think how we can kind of leverage it. But I do think, look, finance is going to be a key component to this thing. It gets back to single data gathering process, drive automation where you can. At the end of the day, this needs to have the right level of precision and controls, because it's I think investors and suppliers and customers are ultimately going to rely on it.
Thanks, Eugene. In fact, we've received a an interesting question from an audience member that we'll return to you with later on in the webinar. For now, we'll just move to look at the reporting standards perspective with Elizabeth Seeger. Thank you for joining, Elizabeth. Elizabeth, you're a board member, US board member for the International Sustainability Standards Board. It's great to have you. Thank you for making the time to join us. Obviously, the IFRS standards for disclosure of sustainability-related financial information is a game changer for the capital markets and for the accountancy profession, given they bring together financial and sustainability information and reporting in various important ways. So this obviously brings into play finance and accounting professionals, particularly in what we have titled an integrated mindset. So as Eugene referred to, sort of being that strategic business partner, breaking down silos, connecting sustainability and financial information, and enhancing the quality of information on sustainability risks and opportunities. I think the IFRS disclosure standards are really going to serve a critical purpose now as a global baseline. Can you just sort of highlight some of the key concepts and requirements in both IFRS S1, which covers the general requirements for disclosure of sustainability-related financial information, and of course S2, which covers climate-related disclosures, and how you feel this places finance and accounting professionals in this space?
Thank you, Stathis. And first, on behalf of the ISSB, I want to thank you for the partnership and the role that you're playing in supporting the establishment of the global baseline that we're all working toward as it relates to sustainability disclosures. Just before I answer your question, I spent the last 13 years before I joined the board at the end of 2022 doing a number of things, including overseeing my own firm's public reporting as it related to our sustainability-related performance. And in the last couple of years in particular, the partnerships I had with my internal audit, accounting, and finance and data teams were really among the most important and also impactful of the relationships that I had as it related to that work. And so I really appreciate the work that you all are doing as it relates to building those connections and also helping us develop this common language across the different functions and organizations. So thank you for that. So I'll answer your question at a super high level and also just flag for everybody's reference that there are online resources that take an hour-long plus dive into each of the standards that I'm going to sort of do a high-level skim version of, make sure that you all are aware that that's there, lots of additional resources coming. But in a nutshell, why I'm really excited about the standards is that we're bringing, and people may have heard me say this before, but the discipline of accounting to sustainability disclosures. We're all learning each other's language to build this new common language to develop information that is really investor-grade information, as the title of the webinar states. So S1, as you mentioned, excuse me, is our general requirements document, and it's really about that accounting discipline that I mentioned. So in terms of content, S1 asks for disclosure of information about sustainability-related risks and opportunities to meet investor needs. That means specifically, as specifically as you can get on this topic, sustainability-related risks and opportunities that could reasonably be expected to affect the company's prospects, its cash flows, access to finance, or cost of capital over the short, medium, or long term. In other words, right in the sweet spot of sort of the accounting teams and the finance teams within organizations. And while sometimes talked about separately, S1, our general requirements document, does need to be used along with S2, our climate standard, or actually vice versa. Our climate standard needs to be used along with S1. And I'll describe S2 in a moment. But that's because S1, the general requirements document, sets the really important groundwork for all other disclosures of the ISSB, including concepts that are particularly important and critical to this audience, such as establishing key concepts around connected information, value chains, and which sustainability-related and climate-related risks and opportunities to report on. Among the concepts introduced in S1 or described in S1 is our focus on materiality, which again is that investor lens. S1 also sets out the qualitative characteristics of the information to be provided, such that it be relevant and represented faithfully, and sets out the other requirements for reporting, such as the reporting entity, the timing and location of the reporting, and connections and comparatives in reporting. So all of these really critical to this particular audience, and also critical to how companies disclose on climate-related risks and opportunities. So speaking of which, S2, which is our climate disclosure standard, again, is focused on climate-related information to meet investor information needs, and as such requires disclosure of material information about both risks and opportunities, including physical and transition risks. So not just greenhouse gas emissions, though that's an important aspect of it, but also really company strategy, governance, and risk management, among other things as well. It, like S1, which I forgot to mention, does require industry-specific disclosures, which are supported by accompanying guidance built on the SASB standards, the Sustainability Accounting Standards Board standards, of which your audience may already be familiar, as many companies have been using the SASB standards for voluntary reporting for many years. And it also includes expectations around disclosure of strategy and decision-making, current and anticipated effects, and climate resilience, as well as scopes 1, 2, and 3, all subject to that materiality consideration that I mentioned as well. I think really critical, and then I'll stop on this question to this particular audience, really critical to this particular audience, and also to the goal of better data quality generally, is that the standards require that companies disclose how and why a company has used specific inputs, the assumptions and estimation techniques to measure greenhouse gas emissions, and any changes that is made to this year over year as well. And ultimately, I think the two prior speakers provided great examples of how this assessment can be done, but in fact, the disclosure of how it's done will really help in terms of the investor grade quality information that we're all seeking to achieve as well.
Thank you, Elizabeth. Yeah, you made a really good point there. A lot of the expectations are around disclosures explaining, assumptions, estimates, and how processes have been implemented. Can you just elaborate a little bit more on something I think that's just so critical about the ISSB standards, which is around connectivity of financial and sustainability information, and the link between information, but also the link between ISB and ISSB standards. So connectivity, I think, sort of is important in some different ways. Perhaps you can just highlight some of the different ways that it's important in terms of the ISSB standards, and then in terms of the connectivity to the financial statements.
Yeah, Stathis, I agree. It is really important. And in my past role, I often said sustainability issues are business issues and therefore need to be managed as business issues. And so I was really very excited when the ISSB was created as sort of a partner board to the IASB, the International Accounting Standards Board. Before I go on, I do think it's important to note that the ISSB standards were written to be GAAP as agnostic, such that one does not need to be an IFRS financial reporter to use the ISSB standards, but recognizing that it's really, sustainability topics as it relates to investor needs are really well aligned with how companies should think about financial disclosures as well. And putting those two boards together, I think, is a really important outcome for all of us. As it relates to the standards themselves, IFRS S1 or Standard 1, the general requirements documents, asks for information that enables the understanding of the connections between sustainability-related financial disclosures and the financial statements. And as part of this, the disclosures I think there are a number of things to keep in mind, including that the disclosures under the ISSB standards are prepared for the same reporting entity and reporting period as the related financial statements. And they're provided at the same time as the financial statements and as part of the general purpose financial reports, recognizing that many companies are not at that point where you can provide this information at the same time today, there is a relief period built into the standards in terms of when that kicks in. And then finally, the S1 is sort of in the concept, in the context of connectivity, requires that companies include data and assumptions that are consistent with the corresponding data and assumptions in the related financial statements to the extent possible, considering accounting requirements. So those are some ways the standards themselves also build on this connectivity directly with the financial statements.
Thank you, Elizabeth. That's really, really helpful. We'll come back to look at some of the other aspects of the standards in the discussion that we have in about 10 minutes. I think some people might be interested in reliefs and other sort of important things to consider in adopting the standards. So let's just quickly move on to Mike Harris, your ESG services leader at PwC Canada. Welcome. Thank you for your time. And I know you're about 3 hours behind, so it's early in the morning for you. So thank you for joining us. And I know, you've been involved in this space for a very long time. So it's great to have your expertise at the table. Accountants, of course, work on both sides of the fence, in both within companies, of course, and within the firms, providing advisory and independent assurance. So we all know that to be trusted, sustainability disclosure really needs to be subjected to high quality, independent external assurance. And this is the path that regulators are increasingly going down to drive confidence in sustainability related disclosure. So being audit ready is going to be a huge challenge for many companies as they collect relevant data and implement the right, the appropriate processes and systems, as we've spoken about before. Just in terms of your perspective and your work at PwC, what do you see are the sort of needs and how are PwC helping companies prepare themselves for improving their reporting and getting ready for assurance?
Thanks, Alice. Yeah, there's been a lot of focus, and there is right now, on companies and how they can enhance their governance and related processes to produce that relevant ESG data, and as you said, to be audit ready. And no doubt, many companies have a lot of work to do in this area, especially ones that haven't really focused on it. But I think it's, what I've learned, and it's really important to note that there's lots of companies that are already getting external assurance. And both Jane and Eugene mentioned there's lots of skills out there already, and it comes from that kind of experience. Yes, there's new reporting standards that Elizabeth just alluded to, and but for companies that have already been adhering to existing standards, and although they're going to be quite different, there's some muscle memory, I think, that's we're going to see. And for those companies that have been doing it and aren't starting from scratch, it's going to be a lot easier, and they can draw upon that. Or companies can draw upon people who've got experience elsewhere if they haven't started it themselves. So you might ask, why have companies been doing this voluntarily? Well, you've heard already, it really comes down to what investors are looking for and other users of GHG and ESG reports. And it's their views, not just regulators out there. So that's why we've been seeing this. And we did a recent investor survey and found that 89% of the investors reported that they feel ESG reports contain some greenwashing. It's probably not a surprise to a lot of people here. So the need for assurance and investor grade reporting is pretty key to address that. The same investors said 70% that found it important that those ESG metrics being reported on are assured. So there's no doubt this isn't just something that's going to come from regulators. We know the SEC's talked about this, but it comes down to the investors putting their money into these companies and what they're looking for. At PwC, we've been on this journey for a number of years, again, with those clients that are doing this voluntarily, but also have other specific regulatory regimes they have to report under. To answer your question about, is external assurance that they're coming as a changing behavior, in terms of governance processes, data, I think the answer is yes. In fact, I see clients paying more attention to audit standards than I ever have before. They, of course, have to pay attention to, what's coming from the ISSB on these reporting standards, because they're the ones doing the reporting. But I'm finding clients are spending a lot of time thinking about the audit standards and being ready for that. So that concept of audit ready, not just from the auditors coming in and getting ready for it, but actually thinking ahead and how that's going to improve your reporting. I think a lot of people are looking to those standards to help them fill the gaps they have there today.
Thanks, Mike. That's really a helpful introduction, and you're absolutely right. IFAC research, our state of play research, shows quite a high level of assurance on sustainability-related information, in particular markets, with it increasing all of the time, as you quite rightly said. I think a lot of that assurance has been focused on metrics, KPIs, and obviously the nature of sustainability related disclosure involves quite a lot more qualitative information. How does that play into the way you would sort of advise companies to prepare for assurance sort of beyond metrics, if you like, and the evidence that's kind of needed to support that process? Yeah,
it's well, both. I think Jane, you said it around, there's a lot of similarities to what we see in the finance world. Of we just have been doing financial reporting for so long, maybe we've forgotten that we just didn't take a set of financial statements and magically figure out a process. You had to step back, and I think this is in the IFAC 8 steps to GHG reporting. I think it's a really good document to look at. In fact, we have 6 key steps at PwC we take our clients through, and they're probably the same, just in a different put in different groupings. But number one for us is developing an overall strategy for this. So understanding what your capabilities are today, what your North Star is, understanding the regulations that you have. You might not just be, you might be a U.S. company and think about the SEC rules, but if you really look beyond it, do you have operations in Europe and need to address the CSRD rules? What are your investors and employees thinking? Have you even polled them? Do you know what kind of metrics they're looking for? Many companies sometimes dive into this without that step back. So that's step one. Step two is choosing the standards and metrics that you're going to use, and so before you've even done anything, you've taken 2 steps to figure out kind of where the path is going. And then third is looking at your data collection and management strategy. Is there a lot that's manual, as Eugene alluded to, and needs to change? And only then do you hit the 4th step around developing processes and controls and governance. And if you think Sarbanes-Oxley, but for ESG, it's kind of like that. And this is where finance can really help, with have the experience that many ESG professionals, they understand GHG data and the background, but they don't have that background in process controls and governance. And that's where that collaboration coming in is really key. And then you can start thinking about tech enabling and operating. And Jimmy's going to obviously talk about that. Many companies jump into that a little bit too early, looking for a bit of a silver bullet. It's really critical because you can't do this manually for a long time. But at the same time, if you haven't done these other steps in advance, you can get into some trouble. And then you're ready to publish the 6th step. So, whether you follow that or what IFAC has put out, I think that's a really good place to start.
Thank you, Mike. We're going to return to some of the points that you made, particularly around the internal control environment, in just a moment. Let's just move to Jimmy Greer, ESG specialist at Datamaran. I actually have known Jimmy for a number of years. Jimmy used to work at one of IFAC's largest member organizations, the ACCA, and at Moody's. So it's great to have you again with us, Jimmy. You've been involved in some of our Climate Week events in the past. Obviously, Datamaran is a leading tech and data provider in this space, and you do a lot of research as well. Can you tell us a little bit about what your research is discovered around disclosure trends and issues that need to be addressed to enhance understanding and disclosure and what's going on in companies?
Yeah, sure, absolutely, Satterton. Yeah, thanks very much for the invitation. It's great to be back working with IFAC on these issues and engaging with the profession. I think from our side, so for us at Datamaran, we're an ESG risk management platform. We're taking lots of AI, lots of data, and using AI to create actionable insights for the companies that we work with, and to help them sort of identify, prioritize, and monitor ESG risks and opportunities. And so one of the things we're able to do with all of this data is kind of look at those trends, those underlying trends of what's happening across disclosures. So from looking across sort of sustainability reports, but also financial reporting, 10Ks, so on. And I think what piece of work that we've done that I wanted to highlight today, which I hopefully provide some context to sort of where we're up to, your piece on GHG emissions with Women's Business and some of the areas that we've covered today, to see sort of what companies are doing, where are they up to. And we looked at S&P 500 constituents to sort of take a sample of companies and explore where they're up to on GHG emissions and what they're talking about across their disclosures. And we found that 96% of those constituent members of the S&P 500 were disclosing something around GHG emissions and climate change. And one of the things that we also look at within that is, where is these disclosures happening? Are they happening in sustainability reports, or are they happening in financial reporting in 10Ks in this case specifically? And to sort of think about that progression of the kind of processes, really, so that it's able to be reported in that more rigorous environment. And I guess encouragingly, 89% of those who were disclosing something were disclosing that within their 10K. So, you know, it's demonstration that the sort of that thinking process that we've all been talking about, that other colleagues on the call have been talking about, of sort of putting those systems in place and getting the right people together, and then thinking about that process of improving, sort of moving towards investor grade information, is underway for climate and for GHG emissions. I think, you know, another part of the work that we're looking at, so I guess that's a sort of starting point. Another thing that we looked at is around targets, right? So the ability to set reduction targets, again, as a measure of demonstrating, well, okay, you know, we've kind of got some thinking around this. There's some oversight around the target setting process as well. And we found that 60% of S&P 500 constituents are disclosing a measurable GHG reduction target. We'll disclose that in 2023. And to think about the progress over the last 5 years, just let me get this right, sort of talking through the numbers, 52% of those who've disclosed this target over the last year were doing so in their 10Ks, and that's up 20% in the last 5 years. So we can see the real sort of influence here of Task Force for Climate-Related Financial Disclosures work. And I guess looking ahead, as this is for last year, people are thinking about what's coming down the track, be it the IFRS S2 climate standard, be it other pieces that may be coming along. Clearly, you know, in terms of targets, and that target setting being something that is maybe a step on, you know, is actually a super important piece of this. There are roughly 35% that aren't disclosing a sort of meaningful, that aren't doing sort of measurement around, well, GHG emissions reductions targets. They're not disclosing anything. So there is some way to go, right? But to put this in sort of context, I think this is really important for us thinking ahead, as now that we have the standards coming in, both the European standards, but also the IFRS standards, and maybe something coming from just the general tightening of the requirement landscape generally. When we look at other issues that are sort of related or adjacent to GHG emissions, so we're looking at all of them, but to pull out a couple of examples, water, thinking about it from a well, clearly it's absolutely a climate central issue. Only 28% of companies that are constituents of S&P 500 disclose any kind of target related to water. And when we sort of go at this, despite this being a topic that they're talking about, there's a lot of emphasis being placed on this topic within their disclosures in general. But in terms of actually being able to get to that point where they're putting a target on it, very low. And when we take that even further and look at other issues, biodiversity being one, our research found that only 1% of those constituents are putting a target on biodiversity and disclosing that. Now, sure, that's kind of going to be, let's say, context specific to industry, and that might well be the case. But I think what the point I'm want to make here is, we talked about sort of, what we're able to see with the climate related issues and GHG emissions disclosures is that progress has been made over that sort of, let's call it TCFD cycle, and then into where we're moving to now with the mandatory requirements coming in. biodiversity, the framework for the Task Force on Nature-related Financial Disclosure released their final framework yesterday, which is fantastic progress. We've sort of got to think about the sort of the time frames, the sort of reporting cycles that are going to be needed to sort of, and the sort of systems that are going to need to be put in place to kind of even reach the level of where we're up to now with climate-related financial or climate-related disclosure GHG emissions appearing in financial reporting suites. Now, the standards may well boost that, but it's just, I thought it's an interesting counterpoint just to see where we're up to and where we need to go and where those kind of need for acceleration around all these things we've been talking about the governance, and then moving through into being able to set up the controls, and then moving out into kind of having the management information to make decisions, and then of course supporting disclosure preparation as well. So that's sort of a quick sort of summary of the stuff that we've been seeing recently.
Yeah, thanks, Jimmy. I mean, it's a really important point. It goes a little bit back to connectivity and integration. Obviously, one of the most complex aspects of achieving sustainability and meeting objectives is that you can't just take, you know, emissions and climate in isolation. The connectivity between your impacts on air, water, soil, you know, nature are all kind of intertwined and interconnected. So well, I'm going to come back to you just in a moment, Jimmy, to follow up on some issues around internal control and climate governance. I'm going to try and blend in some audience questions with some follow-up questions for the panel. Just returning, Jane, to Scope 3. Obviously, Scope 3 emissions arising from the value chain typically accounts for the largest proportion of emissions for most or many companies. Can you just sort of speak a little bit about how to take some of the effort out of Scope 3 GHG emissions accounting by using financial information as the starting point?
Yeah, absolutely. Scope 3 is, for many companies, a bit difficult when they start looking at it. But in reality, if you look at the financials, they might give you a really good hint at which of the 15 sources defined by the Greenhouse Gas Protocol for Scope 3 are at least financially important for you. And therefore, you might be able to identify which of these sources should we focus on developing methods and accounting principles for collecting / calculating. That is one thing. The other thing I would like to say is exactly this about making accounting principles. As Mike rightly indicated before, if you are to have assurance of your data, it requires that you are really, really strong in defining how do you do that? How do you calculate it? How do you get the data? How do you actually validate that it's right and not the least complete? And the completeness is, of course, the difficult part for Scope 3. That is obvious. But if you have defined how you collect it and how you will at least make it likely that it's complete, then you are far, far better off. And there are many, many tools out there, and you can also see them in our guidance on how you can calculate Scope 3. The easy ones are those which usually are mentioned for strange reasons, namely the ones for suppliers. There are a plethora of different kind of solutions for that. That is not the difficult part. The difficult part is downstream. That is for you to get the data from your customers. That is super difficult. And this is where you will have to define how will you actually make these estimations and also get your assurer to say, yes, that is a reasonable way to do it.
Thanks, Jane. Jane, that's very practical. And Eugene, just to follow up with you, and someone's asked a question about how does the finance team ensure completeness of information related to GHG reporting, but it's also an issue for all forms of information related to sustainability. Have you got any thoughts on just how to approach completeness?
Yeah, look, I think over time, you're going to continue to evolve this, right? As you get more data, you're able to run more analytics, and there's a cause and effect on each of these. So the electricity example, you've got good confidence over the dollar value of electricity. You can easily triangulate that with the production output in a facility, and you can just simply say, what's the average price of power? power is more expensive in the summer, and the winter months less expensive in the shoulder months. So there are analytics one can run. The issue we have is with a lot of these, we implementing it prospectively only, so you don't have a lot of historical information. So I think you need to triangulate a few different ways. Over time, I think as you start getting better baselines and better history, you are going to kind of run some analytics here. I think this is where some of those automated analytics are going to come into play. And I think those become helpful for a lot. The Scope 3 stuff's hard because you're a step more removed from that. We leverage some of that because we service a lot of the equipment that we sell, so we have some of that in our systems, but we're facing the same thing Jane had as far as how do you go and gather that.
That's great, Eugene. Thank you for that. And Elizabeth, I think you're going to give us hopefully a little bit of good news, which is that in terms of the rollout and adoption of the IFRS sustainability standards, disclosure standards, there's going to be some reliefs around Scope 3, I believe.
Yeah, thank you for that. Yeah, in our exposure draft for the standards that was out at the sort of mid 2022, we sought feedback on the point of value chain and in particular Scope 3 emissions. And based on the feedback, we heard that and know that many of the risks and opportunities for companies as sustainability related risks and opportunities for companies sit either up or downstream of the company's operations. And we also heard that today the data is bad and or hard to measure and report, and we understand that. And so, the standards themselves, as it relates to Scope 3 emissions, do introduce a number of reliefs or supports or guidances. For example, there's an exemption from Scope 3 emissions reporting in the first year of applying S2. So Scopes 1 and 2, yes, in year 1. Scope 3, there's a 1-year lag. There's the relief to in terms of the permission to include information obtained from companies or partners in the value chain that have a different reporting cycle. There's a sort of a standard accounting support as it relates to using reasonable and supportable information that is available with undue cost or effort at the reporting period, and also guidance in terms of framework for Scope 3 measurement that incorporates the use of estimation. But I think what's really important to remember as it relates to the ISSB and its climate standards is that this is related to identifying risks and opportunities for companies in the value chain, and it's not a numbers exercise. It's really to understand what is material for a particular company based on its industry and activities. And so the standards do require a consideration of all 15 categories of Scope 3, but don't require reporting on anything that's not considered, relevant to a particular company. So as a company goes through the process of identifying or looking at Scope 3 emissions, it's really important to understand where are my particular risks and opportunities as it relates to Scope 3, and using the industry-based guidance as in S2 is an important starting point for that. And then acknowledging or disclosing which of the 15 categories you are disclosing in your Scope 3 emissions is, again, part of how we get to the investor grade data, where investors are actually able to understand what is and what is not in a company's Scope 3 disclosures.
That's really helpful. That brings in Jimmy quite nicely, because I don't think we can underestimate the importance of the risk and materiality assessment in order to get prioritization, to focus on what matters, particularly for making business decisions as well as for disclosure. Obviously, your focus is very much in that risk and materiality space. Can you talk a little bit about how you work with companies to get that focus and that prioritization?
Unmute. Absolutely, Stathis. Yeah. So I think, for us, we're coming in as side of helping companies identify these risks and opportunities and prioritize them, and do that as they're going through the process of moving along into figuring out the strategy, moving out to the end to sort of decision making and disclosure, and sort of turning that into more of a journey rather than a sort of a linear process, as it were. typically what we find with our clients when they're sort of with our customers, companies that we work with, when they're going down this sort of approach, and I think for climate governance, it's more advanced than other areas of ESG, absolutely, because of the steps that we've all been talking about to do with the sort of history of TCFD and those kind of elements as well. You know, sort of simply put, I think, and something that you guys have highlighted in your research as well, is that initial phase of bringing people together is actually probably the most important thing. And those, and sort of simply put, that those cross-functional teams of bringing finance with sustainability, but also risk and legal colleagues, is something that we see happens in different ways in companies, but typically that's a sort of a big first step to sort of start trying to figure out, well, what is this going to look like for us? We are now, as you mentioned, Stathis, I used to work at ACCA, and when I was at ACCA and connecting with yourself and with Jane over the years, the role of ESG controller didn't exist, or that sort of person wasn't a part of the landscape. And now actually we're talking to people who are running that kind of role, either in a sort of standalone capacity, or maybe they're group controller and it's become part of their existing work. This is sort of a sort of standard practice now. So we can see that sort of, and with that, as your research has sort of identified, there are those sort of challenges of sort of bringing people together to understand different types of information and who the issue owners are and what that might look like. You know, there's a lot of similarities with financial information, but there are also some differences as well. So that's sort of where we see how we see these things sort of coming together. I think one really interesting element is that, you know, for us to mention is that the standards have actually been the standards. Fine, there's a lot of information about metrics and targets that are part of the standards, but actually the standards are really about the governance approach. Well, really, they're just as much about the governance approach. You know, there are disclosure requirements. If you look at S2, the climate standard from IFRS Foundation, you know, it's asking you to sort of to identify what is the type of information that that oversight committees are going to be looking at, and how often are they going to be looking at this information? You know, what is the body going to be? How is the body that's overseeing target setting going to be set up, and what kind of oversight is being exercised over these groups? These are disclosure requirements now, and those are sort of really also helpful steps for helping companies, and they're using these disclosure requirements as a way to sort of set up these systems and do these in a way that makes sense, as well as being able to meet the requirements. I think it's a really interesting, you know, we've often had this challenge in our space of there being a lot of disclosure and many challenges around management information and decision useful information. Actually, we're starting to see these two worlds sort of come together, these two halves of these of this sphere come together, where management information and sort of decision useful information is coming together and being sort of much more closely aligned with the disclosure piece of the puzzle as well. And so I think that's a really encouraging step forward.
Thank you, Jimmy. That's really great. We've only got a few minutes left. I really want to finish off on something that's incredibly important to many finance and accounting professionals. And indeed, someone has asked a question about you know, the effective risk management in an internal control environment. Perhaps, Mike, I can just start with you. I think one of the sort of interesting conversations we're now having is the extent to which we can apply the concepts and principles in internal control over financial reporting to sustainability related disclosures. So obviously, Jimmy quite rightly said there's some key differences with sustainability information and reporting processes. But in your view, you know, what do you think is the answer to that sort of question in terms of how to apply an effective internal control environment over sustainability reporting?
I know we only have a couple of minutes, but you know what I refer people to the COSO framework. I mean, we know it's the de facto framework that is from a financial reporting point of view, but many people forget, yes, it came in around Sarbanes-Oxley, it became the de facto standard, but in 2013, they took out financial from it, and people have been applying this to sustainability data already. And if you look at earlier this year, they issued ICSR, Internal Controls over Sustainability Reporting. You see the COSO queued, you see the the 5 components, you see the 17 principles, they're essentially the same, and just substitute sustainability information instead of financial. Now, that makes it sound simple, but if you look at my experience where I see the biggest control weaknesses or errors in sustainability information, it's things like, Jane, you mentioned it's very, coming up with GHG calculations, it's pretty simple. Some qualitative factors multiplied by an emission factor, you get your number. How many times I see nobody reviewed the emission factor properly, we have the same one they used last year, it's not relevant, the assumptions don't work, and the number is materially wrong. That's internal control. So having the right processes, the right reviews that you would expect on a finance side, that people review useful lives of assets, fair market value of investments and whatnot. There's processes around it. Same kind of processes around risk assessment and control activities and reporting. It's just applying them in a GHG situation or sustainability data situation.
Thanks, Mike. And if you want to see that COSO guidance, I think it's really, really useful. It really gives important information on how to apply the 5 components of COSO and the 17 principles to sustainability information. So I want to encourage everybody to look at that as well. We've run out of time. I haven't moved for the last hour, so the light in the office that I'm in at the moment hasn't detected any movement and has switched itself off, and that's why I'm in darkness. So that's IFAC's climate action on the ground taking place. So that's great news. We're walking the talk here at IFAC. So it's been a very timely conversation. I really want to thank Elizabeth, Jane, Mike and Jimmy for taking an hour out of your day in the preparation that you've done for this webinar. We've learned a lot. Hopefully all our 1,000 participants have taken away some very useful information. We've heard some very important perspectives, and we've provided some useful tools, I think, and some reference points to people to go and find out more information and get the support and guidance they need. So you can watch the recording of this on the YouTube channel. We'll be notifying all registrants when that recording is ready, and we wish you all well and a good rest of the Climate Week. Thank you, everybody, for joining.